Hi everyone, welcome back. I hope everyone is safe. Yesterday, Franklin India announced that they're shutting down 6 of their funds. This news came as a shock and got every mutual fund investor worried. So what happened? What does it mean for the investors in this scheme? And what should a mutual fund investor do now? We'll cover all of this in this video. Hi, I'm Mahesh Kabra, founder TaurusCap, and this is our investor education initiative where we're going to be coming up with a series of videos to educate you about your investments. If you have any queries or if you want us to cover any topic, you can put that in the comments below. Now let me start with a little background. Franklin India as a fund house has always been a little aggressive in managing their debt funds. They've always added lower quality paper to a certain extent of their portfolio to increase the overall returns. These lower quality papers typically come with a higher yield, but at the same time they also come with a risk that the money may never come back if the company defaults. This risk is called credit risk. So Franklin have been running this credit risk strategy across all their debt funds for a very long time. So if nothing happened for so many years, what happened now? In the last 1 month since the lockdown was announced, and even before that when coronavirus outbreak became a threat, equity markets started correcting. A similar situation happened in the debt market where FIIs and institutions have been selling. Because everyone is looking for a safety at this point in time, there have been no buyers for low quality papers. Hence, the market for low quality papers have become completely illiquid. At the same time, Franklin investors have also been redeeming from these funds. So Franklin India as a fund house has to sell the assets of the portfolio to return money to these investors. Now, because they're not able to sell lower quality papers, they had to sell higher quality papers and return the money. But this redemption pressure kept on increasing and they were not able to sell the lower quality paper at all. So Franklin India Fund House decided that they want to shut the funds so that there is no further redemption pressure. By shutting the fund, they have stopped all the transactions that can happen in the fund, like there will be no further purchases, there will be no redemptions, no SIPs and no STPs. But does that mean that the investors has lost their money? The answer is no. So this is actually for the benefit of the investors. All the investors will be treated at par. If the funds were continuing in operations, some investors would be asking for the redemptions and they will be paid out by selling the good assets. And the investors who are not asking for the redemptions will actually be sitting with a portfolio of low quality papers. Hence, some investors who are not redeeming will be actually at disadvantage. Now, by shutting these schemes, they have put all the investors at par that every investor will be paid out once the maturity of the paper happens or if they are able to sell the papers. That way, in the interest of all the investors is safeguarded. So before we go ahead, let's talk about which are these schemes and what is the asset under management of these schemes. So here is the list on your screen. Franklin India Ultra Short Bond Fund with an AUM of 10,000 crores, Franklin India Low Duration Fund, roughly AUM of 2,700 crores, Franklin India Short Term Income Plan of AUM 7,000 crore, Franklin India Dynamic Accrual Fund 3,000 crores, Franklin India Credit Risk Fund 4,400 crores, Franklin India Income Opportunity Fund 2,500 crores. These numbers are as of March 31st, 2020. AUM for some of these funds may have reduced over a period of time as the redemptions might have happened. What's another important thing to look at is the average duration. If you look at it, Franklin India Ultra Short Bond Fund has a duration of 0.38 years, which means 4.5 months. We'll use this further in the video. So what should an investor do? Frankly, there's nothing that you can do if you're an investor in any of these 6 schemes. Now everything is to be done is by Franklin India, and what they will do is that they will sell these papers as and when there is an opportunity in the market, or they will wait for the papers to mature and the borrower to return the money along with the interest component. As soon as that money is received by Franklin, it will be paid to the investors on a proportionate basis. So you can be rest assured that your interest will be safeguarded. There could be a little bit of a haircut of the overall investment amount that you have, but your money will be back. So nothing to worry about. Another question is, how long will it take for the money to come back? Here, the duration of fund is very important. As I told you, in like Franklin India Ultra Short Bond Fund with a duration of 0.38 years, which means around 4 to 5 months, in all likelihood, Ultra Short Bond Fund investors should be able to get their money in the next 4 to 5 months. Why and how? Basically, as the paper matures, the borrowers will return the money and Franklin will return the money, in turn return the money to the investors. And if there's an opportunity and Franklin is able to sell these papers before that in the market, they will sell and return the money. So between 5 to 6 months, you should be able to get if you're an investor in the Ultra Short Bond Fund. And similarly for the other funds. But longer the duration, the longer the time will take for the money to come back. Now the next question is, what should the investors in the other schemes of Franklin India should be doing? Now let's say if you're an investor in Franklin India liquid fund, ideally you're not at a risk. But to be on a safe side, if you want to redeem your money and invest in some other funds or even keep in your bank account, that also is fine and is understandable. But I would say avoid any knee-jerk reactions. If there was any risk to those funds, Franklin would have taken action accordingly. And the last question to ask is, what about if you're an investor in any other fund house? And here we are only talking of debt mutual funds. So if you're an investor in any other fund house, in let's say a liquid or a money manager or an overnight fund, in all likelihood you're out of risk. But if you are an investor in a credit risk fund in any other mutual fund, then you should review it. Right now, it all totally depends on the quality of the portfolio of the debt scheme that you're invested in. Next few weeks, there's going to be a lot of selling pressure because people are going to panic, people will look for safety, and people will end up redeeming money out of the debt mutual funds. If there's any little risk to the fund that you're invested in, if you're in a fund which is slightly longer than duration than 2 months, then you should ideally withdraw some part of your money to stay out of risk. But again, consult your advisor in terms of the quality of the portfolio and whether you should be staying invested or not. At this point in time, we recommend that you stick to only liquid funds, overnight funds or money manager funds as a choice of your debt mutual fund to park your money only for short term. For longer term, right now we see much more opportunities in the equity market from a 2 to 3 year perspective. For that, we'll be making a separate video on the equity market outlook. If you have any further queries about the funds that you're holding, you can write below in the comment section or you can WhatsApp us on the number given. I hope you liked our video. Do subscribe our channel for further updates and the new videos that we are soon coming up with. Thank you so much.